Hey guys, welcome back. Jeb Smith, Josh Lewis here with your live at 5 update, updating you on the real estate market, mortgage, real estate, everything related to housing. I'm here to answer your questions, help guide you guys through the real estate process, make it easy to understand. Appreciate you being here. Josh, welcome to the show.
I'm happy to be back in the correct time zone. Live at 6 last week just didn't feel right.
We started this whole thing off at 6, and now we've moved it to 5. And it seems that the majority of people coming on seem to be around 6. So, let us know in the comments what you guys think about the time. Does 5 p.m. Pacific Standard Time work best, or would another time work? But as you guys know, we're here for your questions. So start putting those in the comments if you would. That'll help us get the show started and give you guys the information you're looking for. And again, what are you seeing out there in the market, right? I mean, it's been a week. There might have been some changes in the last week. Are you getting your offers accepted? Still putting in offers? What are you seeing? Let us know. Josh, anything happened over the last week that you want to dive into?
Nothing super exciting. We've seen without going all the way into the mortgage rate update, we have seen the 10-year Treasury take a big dip in the last week. We're down to about 130. Mortgages haven't followed quite as closely, but again, at our best levels since back in March. So we've been talking for months here that despite all the silliness in the media that rates are going higher and rates are going to be 3 3/4 by the end of the year, they're not going there. We're actually seeing the opposite. So it'll be interesting. We still have a bunch of silly government intervention. They're buying $40 billion of mortgage bonds a month, and that's going to stop at some point. And I think even how that's going to impact mortgage rates, people somewhat misunderstand, but that's the big thing that we've been looking at this week. If you go through the technical analysis and see everything that's been going on, we're ripe for a correction, meaning when we have a nice move to the good side for us like we've seen, we'll give a little bit of that back, but all the technicals are setting up for rates to continue even lower. So they're great now and likely to slide even lower as we move through the rest of the year. So good news from that front.
No, awesome. And I had all intentions of trying to produce this show a little bit better this week and focus on the person talking and remove the person that wasn't. But I just realized that's going to be a complete pain because if I remove myself from the thing, once I add myself back in, then I change sides. And then it just gets this whole different dynamic going on here. So we're going to keep it as it is for now. And going in the future, we're going to try to make this a little bit more, not user friendly, but, be able to see the person that's actually talking, more of the focus on the screen. But what we're going to do today is dive into your questions. The first one is going to, actually, we got Jennifer Lego here, who is going to help us moderate the chat. She's always here and always on time. So thank you for being here, Jennifer. The first question is going to come from Michael Duree. He's asking, is 20% always required as a down payment when purchasing raw land? Now, Josh, I know here locally we don't do a lot of raw land deals, but know anything about that?
For us, the few sources that I have for it here in California want a lot more than 20% down. So being in Texas and having more land, it's possible that local banks, community lenders are more comfortable with it and will do it with 20% down. All the sources I have here in California are wanting a significantly larger down payment, more in the 40-50% range. And some of the reasons for that, just the higher level of risk. If they had to foreclose on the property, it's a non-performing asset in the truest sense. Most land can't be leased out. I mean, I guess if it was grazing land, something like that, you could rent, or farmland. But most of the things that we're talking about buying are residential lots that you would build a home on. So if the bank has to take that back, there's not a lot they can do with it. They're responsible for paying the taxes. They have their money tied up until another buyer would come along and purchase it. So that's the biggest reason why we see larger down payments. But if you have 20% down in your area, that's actually really good.
No, that's good stuff. We've got Joey Crack here saying, basically seeing prices drop in New York a little bit, but from high levels to start. So not really seeing a lot of change in the market at the moment. We've got people watching from Costa Mesa. Thanks for being here, Ralph. And a lot of people are saying that they're on different time zones, so the time that we're doing it seems to work. Josh, Jose has a question about subprime loans. So, are you seeing any signs of any subprime lending coming back to the market at this time?
Not really. So the laws are different from that time. You have to show an ability to repay. So for a residential owner-occupied property, we have to be able to show that the borrower has the ability to repay. And the generally accepted method of doing that is analyzing pay stubs, W-2s, tax returns, and seeing the income coming in. We have some things, asset depletion. If someone has a large amount of assets, we can annuitize that and say how much money would that generate. We can look at if you need a $300,000 loan and you have $500,000 in the bank, you have the ability to repay. But even those where you're looking at bank statements for average deposits, rents from a rental property as the ability to repay, lenders are making those, but they're at a significant premium. You're paying a 1.5–2% premium to the market. If you go back and look at where the problems with subprime were, people think subprime itself was a problem. It wasn't. We've eliminated it entirely. But if you go back all the way through the 90s, late 80s into the 90s, early 2000s, we had a subprime mortgage marketplace that worked for people with lower credit scores. It worked because it was based off of equity in the property. You had a much larger down payment or a larger equity position in your property. They actually documented that you had income and should be able to make the payment. And there was a pretty big premium in terms of the interest rate. So people were using it when they really needed to. What happened at the end is we had gotten down to, didn't matter the credit score. You weren't paying much of a premium in the interest rate. You didn't have to have any equity in the property, and you didn't have to actually show income to qualify for the payments. You see, it's a recipe for disaster. It's like a four-legged stool. When you start pulling legs of the stool off, we don't document income. We don't document value. We don't require credit. The stool just eventually can't stand. So we don't have any of that. We have options that are coming back into the market that will allow you to work maybe against without one of those legs of the stool, and you pay a premium for sitting on that slightly dangerous three-legged stool.
No, makes a lot of sense. I mean, a lot of people want to, compare now to the previous time, and we've talked about that, and we're not going to go into it now. But the one big difference outside of the laws that are changing is just the loans are way better all the way around with regards to what's required on all fronts. So good to know subprime lending is not making any headway at the moment. But I have my own question before we go to another question. So I received an email today from a viewer who was asking about being in a position where they essentially don't have the income to purchase a property, but they have assets. And they were asking about asset depletion. And I know we've talked about it just a little bit on a show that's been some time ago, but I thought maybe if you have any familiarity.
One of those things.
Yeah. If you're familiar with it, maybe lead us down the path and tell us what, how asset depletion works in this type of environment and what kind of loans can you use it with?
So you can use it with Fannie Freddie loans. Sometimes some lenders will look at it as basically take the asset and divide it by the term of the loan. So a 360-month loan, take $1 million, divide it by 360, they'll annuitize it that way. It doesn't take into account that $1 million isn't just sitting there. It's invested in one way or the other. So the most conservative guideline is to look at something like the 10 or the 30-year treasury and give it that yield and say that it's generating some money, which will stretch it over a longer time frame. Probably the biggest thing that you have to look at is if you're using retirement accounts, you're not of retirement age, they're going to give you a big haircut on that because they know that you're going to both get taxed and penalized if you were to take out a chunk. So maybe we're only able to use 70 or 80% of a retirement account if you're not of retirement age. So it's a little bit complicated. Big spreadsheet we go through, we gather up all your assets, what type of investments are they in? Is it in cash or is it in equities or mutual funds? How old are you? And then is the lender going to use some type of return on that money? And it gives us a big long number. Now that's for your Fannie Freddie best loan types available. We also have a couple of portfolio lenders for us here in California that banks that lend, and they will use that on bigger jumbo loans. And then you have non-QM lenders that, like I was talking before, we have a lender, they call it ATR in full, so ability to repay in full. So if you want a $300,000 loan and you have $350,000 sitting in the bank, they say, well, you've shown the ability to repay because you have the money to repay it in full, but that will have a premium in terms of the interest rate. And remember, all of these things, any down payment, closing cost is going to come off of those assets. So again, if you're putting 20% down on a $500,000 property, you have $1 million, we're going to take $100,000, $110,000 off of the annuitizable assets to arrive at the figure. So if it's something that you're interested in, make sure you check with a loan officer that's familiar with it. Not all lenders will go along with it. So it's just important that you're dealing with someone that actually knows how to do it and is getting you an accurate calculation and maximizing your ability to qualify for the loan with it.
No, and we always talk about working with a professional, and that is one reason right there is somebody that knows the products. I mean, the guy in the call center is not going to know that in most cases, right? They're just checking their box with the easy loans, and anything that is outside of that box, they're not doing and likely don't know how to do. But let's continue to move along here. Logical thinker, also a normal.
Regular, bro.
No, I like normal. He's
regular. You don't know that he's normal. You don't know that he's normal.
Maybe it's
he or she watches you on a regular basis. How
clearly
normal
not
can
normal.
they be? Yeah,
clearly not a normal person.
Exactly.
Logical thinker. As buyers can lose their earnest money for failing to perform, is there repercussions for sellers failing to perform? When are sellers legally obligated to sell to the buyer? So this is a very good question. What happens is when you're purchasing a property, if the buyer doesn't perform, it's really easy for the seller to send a notice to perform. And, typically that's 48 hours that the buyer has to perform based on the residential purchase contract here in the state of California, unless that time frame has been altered. And if they don't perform, the seller can essentially cancel the contract, right? It still requires both signatures from a buyer and a seller to cancel it in order, for escrow money, earnest money deposits to exchange hands and all that good stuff. But the caveat here is on the other side, when you have a seller that's not performing, as a buyer, you can send the same notice to perform. But if they don't perform, then there's nothing you can do as a buyer at that point, really. I mean, you can say, you know what, I'm not moving forward. I'm going to back out of the contract. But at which point you're going to lose the property and there's no money on the line for you to take. Now you could go the route of them not performing and going to try to, arbitration mediation type deal and end up suing them for whatever reason. But at the end of the day, it's probably not going to go very far. So there's not really a lot that's going to happen with the seller not performing. I mean, you can take them to court. You can deal with all of that. I personally haven't been involved in any of that stuff in my nearly 20 years in my career. So I don't really know where it goes after that. But I do know that people have been in that position and they've just chosen to walk away because it wasn't worth going through that process. Josh, do you have any experience on that side with the buyers suing the sellers for not doing their job?
We've never had one actually go that far because most times the sellers realize they don't really have the ability to fight it because they don't have seller contingencies on that side. They have agreed to do something, and if you break the contract, you can be held accountable to it. So it comes down to the question of, if we're talking relatively interchangeable single family tract homes in a normal market, most buyers are just going to go, no, I don't want to go hire a lawyer that's going to cost $5,000, $10,000, $15,000, $20,000. I know I'm right and I should win, but I may or may not actually win. And even if I do, I'm paying a bunch of money to do it. And again, that buyer likely only has $20,000 or $25,000 or $30,000 to complete their sale. They don't want to roll the dice on the lawsuit. So most times the sellers come to their senses and do the right thing. It doesn't happen very often. Generally, when people put a sale out, for sale sign out, they actually want to sell. But when it does, they either come to their senses or the buyers just agree to move on just because of the headaches and hassles and cost of trying to enforce the contract.
Well, I'll do you one better. So this was about a year and a half ago. Maybe it's been 2 years at this point. Had a property in West Side Costa Mesa here in Orange County. Sellers agreed to accept an offer. They signed the offer. It was a fully executed contract at that point. The seller said that they were going to sell the property. They called me back next day, the day after, and said they didn't want to sell the property anymore. Essentially, their excuse was job that was supposed to happen in the state of Montana was falling through. Therefore, they didn't want to sell. They had signed a purchase agreement and basically they were in a position where they had to sell that property. So it fell back on me to try to get them out of the contract because they no longer wanted to sell it. So I had to go to the agent on the other side and tell them what happened. And it basically took some going back and forth. And I told my clients, I said, listen, here's the deal. You can say I'm not selling it. And that's fine, but there's an opportunity for the buyer to sue you at this point. And if they go through with it, chances are they're going to win because you have an executed contract and you've just changed your mind. I mean, they haven't done anything to violate their side of it. The buyer said, you know what? And it took about a week and a half. The buyer found another property, wanted to move forward with the other property, and just said, you know what, we're not going to deal with that. And so they allowed the seller out of the contract. And so it ended up working out for both sides. But, in that case, the buyer could have sued, but they didn't. And like Josh said, it's going to be more of a headache than it was worth. And in that case, the seller probably would have lost. What would have happened? Who knows? Right. I mean, there's got to be some sort of damages there. And the fact that, only 24 hours had passed since that happened, was there really any damage? And that's where you don't really know what's going to happen in court. But let's move along here. So your boy Joey Crack has got a newborn, so he's not sleeping much these days. Josh,
I'll bet
Josh
you
doesn't know anything about newborns.
I'll bet you that baby's a Cowboy fan.
Too funny. Cowboy fan. If you don't know, Joey's a Denver fan. He's a Broncos fan. Esther and Jimmy Andrews, would you refinance a mortgage that just has 5 years left on it right now and invest that money into an investment property right now, or just focus on paying off the initial mortgage? Josh.
I love the question, and often what it comes down to is a couple things: risk tolerance and time horizon. So we didn't get the person that asked the question, we didn't get their age there. It's a different question whether you're 35 or whether you're 70. If you're 70 years old, it's nice to be approaching the finish line there and having it paid off, not having to worry about it. If you're 35, 40, 45, and you have another 20, 30 working years, like everyone still thinks in terms of this mythical 65 and I'm going to retire. And some people get to do that, but people are working later and later, working to 75, 80 years of age. So want to think, how do we keep our money working for us? Once you have that equity tied up in the home, it is not going to be working for you anymore. So as long as you have an investment in another property that makes sense, taking some of the equity, maybe go to a 50% loan to value on your home and put the rest at a big down payment, maybe close to a 50% down payment on a rental property. Those are both low risk. You have a big equity position in those, and the rents will help offset the additional payment for you. And if you've gone with 5 years left to repay, 25 years into that loan or 10 years into a 15-year loan, it probably had a fairly large payment, even though the balance is low. So you may not even be increasing the monthly payment. And as long as you know that you have an income stream coming in up until retirement that can easily cover that for you, generating some additional tax benefits, leveraged appreciation, and building up equity can be a great source. But a lot of times it just comes down to what's your age and your risk tolerance. And like I always say, numbers never lie. Pencil it out and see what it looks like with your projections of what's going to happen with the real estate market in the next 3 to 5 years, and how does it all pencil out.
No, great answer. And like Josh says, I mean, and he said it there, the numbers never lie. Get with somebody, have them run the numbers and see if it makes sense to you, but have a plan, right? I mean, don't just shoot, don't live your life like mine with no plan. Have a plan. It works out better for everyone. So I minimized the question there, Josh. Minimal on the bottom. You think that's better?
I like it.
All right, so we can keep the question up there for those that are just tuning in to see what the question is, but it allows those watching to see your that beautiful head of hair you have. Let's see here, Johnny Co. Can I get a jumbo loan with 10% down and not escrow account required? So, what are the requirements right now for jumbo, Josh?
So yeah, a
And
year
what is
ago,
jumbo for those who don't know?
a jumbo loan is anything over the conforming loan amounts for Fannie Mae and Freddie Mac, which nationwide's 548, 250. In high cost areas, much of California, parts of New York, other areas, you can go as high as 1.5 times that. So it gets us up well into the eights in a loan amount. So for us in Orange County, jumbo stuff is anything up 850 and above, puts us into that range. And we do have 10% down options. The jumbo market was sort of the last thing to thaw and open up. And just prior to COVID, we were finally starting to get some good jumbo loan options and lower down payment. And the jumbo investors just backed out of the market hard when COVID jumped off. And in the last 3, 4, 5 months, we've seen a bunch of investors come back into the market aggressively with reasonable guidelines. So we do have 10% down options. And I can't say with 100% certainty you could do it without an escrow impound account, but I don't see why you wouldn't be able to. We can do no impounds on a 10% down conforming loan. So my guess would be that we absolutely could do it on a jumbo loan. We've got 2, 3 different investors, not just different lenders, because many wholesale lenders and independent mortgage banks are selling their loans to the same place. So there's really only about 3 to 4 lenders making those loans. But my guess would be we could absolutely get you one without an escrow impound account.
All right. We have Edgar here. Edgar is asking a question about purchasing a second home, renting the current one. Does the second home purchase have to be valued higher than the first? And I'm going to say the reason he's asking this question is because a lot of times it's got to make sense to the lender of why you're purchasing another property, right? And a lot of times they want to see, or not a lot of times, in some cases, they want to see the property that you're purchasing actually of a higher value since you're moving one to the next. But Josh, what's your thoughts on that? Or what are the guidelines rather?
There's no guideline. It has to be reasonable and make sense. The only thing that a lender and the underwriter that's helping make that decision is trying to prevent is a loan being made under owner-occupied terms that's actually going to be a rental property. So that's when they're asking questions of, hey, why are you moving from a 5-bedroom house to a 2-bedroom house across the street that's worth 70% as much of this home? They want to know that it's reasonable for you to be moving. Like a lot of times we'll have people that are downsizing. Kids are gone off to college, got married, moved off, and now they're like, we don't need this big house. We want a smaller home, but we like this. We're going to keep it as a rental because we like the market going up. So as long as it's justifiable and reasonable, and what's unreasonable? Let's say for us, Jeb and I live here in Huntington Beach. Even entry-level homes are close to $1 million here. Say you have $1 million single-family home here in Huntington Beach. You work over in Irvine, and you're going to buy a condo in Los Angeles for $400,000. It doesn't make sense that you're going to move further away to live in a lesser home, way away from your job. Now, by the same token, if you had $1 million home and you buy a $650,000 condo here in Huntington, or even closer to your work over in Irvine, it makes sense. It just has to be reasonable and justifiable. And we will go ahead and put a letter of explanation from the borrower in the file ahead of time. Anytime you leave an underwriter to their own devices to start asking questions about if it is or isn't reasonable, they'll usually err on the side of caution and just say no. So it's a key and important part to the process. I always tell people, your story is your story. As a loan officer, we're the editor of that story. We want to make that story as perfect as possible. So when the underwriter picks it up, they're not having to read between the lines. They don't have to wonder what's going on. They can pick up the file and in a short period of time know exactly what you want to do and why it's reasonable for you to do it and a good risk for them to approve it.
I like it. Gma2 Taylor, what are off-market listings? So An off-market listing is a property that someone knows that, someone wants to sell, if you will, but it's not listed actively on the MLS. So I have clients, for example, that are interested in selling their properties, but don't want to actively put it on the market for one reason or another. Now, you see these a lot in times like now where people are trying to find the right property, but don't want to list their property quite yet because they're not sure of the timing, that sort of thing. So, in some areas they're harder to find. But when you have, an area as big as Orange County, there's a lot of off-market listings out there, but the caveat is finding them, right? You have to have an agent that's familiar and networks with other agents. You might have some agents that have a bunch of their own, but typically, it's you need a network, if you will, to really figure out these off-market listings. And there's been some changes with regards to the National Association of Realtors, and a lot of these used to be called pocket listings, and there's different names for them. And so a lot of them have kind of fallen by the wayside, if you will, but they're still out there. So, and in some cases, it allows buyers to get into a property and not have to deal with the competitive situation of multiple offers and that sort of thing. But they're hard to find. So if you're looking for an off-market listing, just make sure you're working with an agent that is local to the area. In most cases, knows the market, because they're going to be a better fit for trying to find those. All right. Jennifer Lego has a question here for you, Josh. What differs between non-QM and subprime? What are the differences in the two? And are there any subprime loans still out there? So that we know there's non-QM loans, but are there any still like subprime loans at all? And you addressed it a little bit a minute ago, but we'll just answer the question as a whole here.
Non-QM is really a new version of subprime. So non-QM means a qualifying mortgage. So there's a qualified mortgage rule that was part of the 2010 changes that most lenders want to make sure that they fall within the qualified mortgage guidelines, because it prevents them from getting sued and saying they were taking advantage or not following the rules. So lenders that operate outside of those non-QM protections, or outside of those QM protections in the non-QM realm, there's some additional risk. And for that risk, both in the loan and then from a regulatory side of it. So when they make those loans, they're going to get a higher rate of return, but they are giving you flexibilities. So the biggest difference is probably the most common non-QM loan right now is a bank statement program. So instead of documenting with pay stubs and W-2s, you give us 12 months of bank statements and they average the deposits in lieu of income. So it's a flexibility, but it's not like what we saw, 15 years ago, 20 years ago, when we would say, well, just tell me what your income is. And you would have a landscaper would tell you that he makes $20,000 a month, when it's just not true. So that's the biggest difference. Subprime had really devolved. And again, subprime was not a bad thing. It existed for 15, 20 years very successfully. What happened is Wall Street's thirst for yield and anything that they could put into bonds and sell led them to say, hey, why don't you go a little lower on credit score? Okay, why don't you go a little higher on loan to value? Instead of documenting with bank statements, which was also a very common in the 90s way of documenting income, instead of bank statements, let's just go stated income and just say what they make. So you don't have that layered risk that you used to have. They don't go as low on credit scores. They don't go anywhere near as high on loan to value. And you're going to document income and ability to repay one way or the other. So subprime just gradually chipped away to where there was basically no standards. You would just look at the credit score and loan to value, and this was what the rate sheet said. And probably the biggest example I would have, I used to run in 2003, 2004. I ran
He's never ran. He doesn't run.
That's so true. I ran consumer direct lending at Stearns Lending. And at that time, we had New Century, which is a big one that you guys have heard imploded. New Century, and I forget who it was, the other one, but one of their big rivals. Their AEs would come in and tell us, what do you have that would normally go into a Fannie Mae or Freddie Mac so we can get you better terms? So they were making so many of the bad loans to low credit scores, super high loan to value, that they would overpay for the good ones so that they were offering good borrowers better terms than stuff that was guaranteed either directly in the form of FHA and VA loans by the U.S. government, or with an implied government guarantee in the Fannie Freddie stuff. And you look at that, you're like, this is nuts. Why is Wall Street paying more for stuff than that is just private securitization versus stuff that is guaranteed by the U.S. government? So that stuff's never coming back, gone, and not coming back in any way. And I don't see people saying, well, they're getting more and more aggressive. Like, actually, no, it's been what it is. You might have more players, and you might have them willing to accept a lower interest rate, so there's more competition for those loans, but they're really just not able to compete in terms of being super aggressive on who they will lend to, because the laws have changed.
All right. Great explanation. Joey's got a question here about renovation loans. So I'll preface this with, basically, a renovation loan is a loan that allows you to purchase the property and do the renovations as part of the loan. So the bank will lend on the new appraised value of the property after the upgrades are complete, and it allows you to essentially pay for those upgrades through the financing of the loan. FHA has one called a 203K. There's also another one, Josh. What is the other one that's out there?
Home style. So
Home
Fannie
style.
Mae has their home style renovation. So the biggest thing in a lot of parts of the country, home prices are so high that I have people calling, hey, we can't find anything. All the prices are up at $1 million, $1.1 million, $1.2 million. We found a terrible house for $800,000. It just needs a bunch of renovation. Well, it falls above the Fannie Mae and FHA loan limits, so we're not able to do that. But Joey, I know you're in New York. I got a good friend in New Jersey that specializes in these. If it's something you get serious about, let me know. I know you're happy with your lender, but I wouldn't go to someone that doesn't specialize in renovation loans if you were serious about going that route. And any renovation loan is going to take longer. There's more involved in it. We're approving you for the loan, and then we're also getting details in terms of the contractor, the scope of work, timelines, all that fun stuff. So I know that I've got a good friend here in California, Scott Nicholson. I've got my buddy Jeff Onofrio in New Jersey. They both cover a bunch of states, and they're still doing business. So I know they're getting them accepted. I just know it does complicate it for the seller, and it's probably a little bit harder to get accepted than a standard offer.
Yeah, and then the second part of the question is asking that are there any that sellers aren't scared of, like FHA and VA? And I talk about this a little bit in today's video. You know, why sellers are scared of those offers based on a recent survey that came out from the National Association of Realtors. But there are, I mean, I showed you what's happening in my market. I think there was 890 something properties that have closed in the last 6 months using FHA and or VA here locally. So people are getting them done. Just going to take a little bit, going to be finding the right property, and having an agent on the other side that understands it. And so just keep that in mind. It takes a little bit of two sides working together to put those deals together in this environment. Judy just went into escrow. She's thanking us for helping her through the process, asking what kind of things can go wrong in underwriting. So I'll let Josh add on to this in just a second, but hopefully nothing. I mean, if your loan officer, your mortgage professional did their job, really the only potential problems you might see go wrong are something related to your employment. Other than that, as long as the lender's done the right stuff up front, then you're probably in good shape. And I guess the other thing could be credit. But Josh, what do you see typically happen when you've done your job and get people, fully approved? What kind of things go wrong that causes people to potentially fall out of escrow?
So look at it this way. The underwriter is essentially like the teacher's aide that they have the answer key, and they're sitting there and just validating that your loan officer and the processor have done everything correctly. They've calculated your income correctly. They've determined your assets and reviewed your asset statements to make sure that you don't have any large deposits, transfers, things that can't be explained. As Jeb said, you've gone through the credit. One of the big things we see, I've talked about this before, that anyone that's done loans for less than 20 years has only operated in the automated underwriting era. So machines are not great at looking at details, and people that rely on machines are even worse. So a lot of times you'll run a credit report through, and DU, the automated underwriting engine, can't see something in there that a human, if they look at it, would be able to see is an issue. So really, underwriting is just validation that the file is what it is. We talk about garbage in, garbage out. They're validating that there was no garbage, that things were done correctly. So the underwriter is going to go through, recalculate income, make sure that your loan officer did it correctly. They're going to look at the appraisal. They're going to look at the preliminary title report, make sure there's no liens on the property that would be problematic. Really, they are there to ensure that the loan meets the guidelines of the agency, Fannie Mae, Freddie Mac, FHA, VA, the jumbo lender, the non-QM lender, whoever sets the guidelines. Their job is just to go through the file and make sure that they actually meet them. From our end, we get people asking all the time, well, should I already have my file go through underwriting before we make offers? And we very rarely do that. I'll do it once or twice a year. We'll have a file that's hairy enough that I want to put it all together and get an underwriter to rubber stamp it before we have someone going out and looking. And that's just because we know the guidelines. One of my best staff members here has been an underwriter for 20 years. So if the two of us can't figure it out with my 26 years of doing this, her 20 years of underwriting, we don't know what we're doing. My processor's done this for close to 20 years also. So hopefully the team that's working on your file is in the same boat and they know what they're doing. They've done a good job of collecting the documentation, asking you for the right things, putting it all together. And at that point, underwriting truly is just a rubber stamp. The underwriter goes through it for about an hour and just make sure all your ducks are in a row.
All right. Joey, thank you for the super chat, $5. We appreciate you and appreciate the support. We got a lot of good questions coming in here, Josh. Let's see here. I want to roll back up here because we were kind of in a roll here. So it's Mish is asking, just got approved for an FHA loan, asking, should I wait until I can get a conventional loan? Now, this is one of those that we answer probably weekly with regards to should I wait or should I buy? And what I would say to make this answer pretty short is if you can find the right property now, you're comfortable with the payment using the FHA loan, I don't think there's any reason to wait. But if you're out there in the market and you're not having success with it or whatever, and the numbers don't make sense for whatever reason, and you're in a position that you're eventually in a conventional loan because you've added additional savings or what have you, then rerun the numbers using a conventional loan and see if that makes sense. I've done videos before where I've talked about doing a 3.5% down FHA versus a 5% down conventional versus a 10% down conventional. And you'd be surprised how many times that 3.5% down FHA ends up being the better of the loan with regards to the monthly payment. And when I say better, I'm talking the least amount of money coming out of your pocket per month with regards to that payment. So, on paper, it may look better to a seller that you're using conventional versus an FHA, but between you saving the 3.5% down versus adding an additional 6.5% down to get to 10% and likely having a better loan at that point, how long is that going to take you? And where are home prices at that point in the future, right? Have they continued to gradually creep up 1-2% a month based on your market? If so, then you're getting yourself further behind. And if you got in it now, not only would you get that appreciation, you'd be paying down your mortgage at the same time. So that's the easy, simple answer to that. But have somebody run the numbers, and if it makes sense, do it. If not, then weigh your options at that point.
Yeah, and I just looked through our numbers here is just for my own edification. 20% of our purchases this year have either been FHA or VA loans. So they are getting accepted. I will say anytime we have an FHA or a VA buyer, we are going to go above and beyond. We always like our agents to copy us on the offers so that we can follow up with the listing agent. We absolutely have to do it on the FHA and VA deals. The biggest issue that I hope realtors know when they're representing their sellers on their listings and talking to them, the only difference here is the typical FHA and VA buyer is less likely to have the ability to make up a shortfall on the appraisal. So if you're looking at a 5% down conventional versus a 3.5% down FHA, and neither one of them have any money beyond what it takes to close the deal, there's really no difference. So those are the questions that I like to have, or the conversations that I like to have with the listing agent, just walking them through that we never have a deal that doesn't close. Literally never in 6-7 years that I have run, that we've owned Buywise here, we've never had a purchase not close. So we want to walk them through that, and then we want to walk through the exact qualification of this. I had a client last night. This is the flip side of it. She's a conventional buyer, actually a viewer here of the channel. Conventional buyer. She's writing an offer, and she was the lowest of 6 offers, or the second lowest of 6 offers that came in, and the agent wanted to know, can she go up? Can she go up? I said, this is the cheapest house she's looked at by about $300,000. I mean, every other property was $300,000 more expensive, and she has, an extra $100,000 in the bank. I don't think you have another offer there in that price range that would be as strong as her. So that's what your loan officer should be doing when you're making an offer. And when you have that, that's how we are able to get FHA and VA offers accepted. I'm not saying it's just as easy as a conventional loan. If a seller has the option to sell to someone with a 20, 30, 40% down conventional loan and a bunch of money sitting in the bank where they can make up an appraisal shortage, they will. But in an area where FHA or VA or low down conventional offers are the norm, we can generally get your offer accepted.
No, and as I mentioned in that video that I put out today too, I was representing a seller, or I am representing a seller here locally, that we just accepted an FHA offer on that property. And the primary reason we accepted that offer was because I called the lender, who I knew on the other side, and because I trust that lender, I know they do a good job, and had a conversation, and they assured me that there were no issues. And I said, well, if they're telling me that, then I believe it, and I conveyed that to my client, the seller, and we moved forward with that offer. It comes down to relationships in a lot of ways, guys, and knowing that the person on the other side is a pro, that's who I want to work with, and so we chose that offer for that reason. So they are happening, by the way. Yep.
Wouldn't you say, even in addition to that, if you hadn't known the person, when you pick up the phone and you talk to a lender, it's not hard. It's not hard to tell how long they've been doing it, if they know their job, and how well they know that file. I'm sure there are some great BS artists out there that could blow one by you, but for the most part, if someone knows what they're talking about. When we talk to a realtor, the guy I talked to last night, you could tell he does a lot of business, and he's representing his seller very well. He was asking good questions, the right questions. And conversely, sometimes we'll talk to an agent and you're like, why are you asking me things that have nothing to do with this transaction and is not protecting your seller in any way?
Yeah, and I can tell you out of I don't know how many homes I've sold this year, 15 or 16 at this time, and I don't know how many of those are listings right off the top of my head. I could calculate it here in just a minute, but I'll tell you, I've only had a very few of those people where the lenders actually contacted me. And I preach this, guys. If you're a buyer and your lender is not contacting the seller, they're doing you, or the listing agent rather, they're doing you a disservice. In this case, I reached out to the lender because I knew the lender, and it was like a quick conversation. But I'm not normally going to call the lender. The lender, it needs to call me, especially in a multiple offer situation, right? They need to help that offer stand out. Now, depending on the situation, obviously I'll reach out. But if I've got 10 offers and I've got some solid ones, and the lender's not reaching out to me, I'm not going to break my neck to go try to find that lender. The lender needs to call to make sure that everyone knows how well qualified their client is. So make sure you have a lender that can do that, and make sure your realtor knows that the lender needs to do that, because as I said just a moment ago, you'd be surprised how many people aren't checking all the boxes. And in this market, you still need to check all the boxes. It hasn't changed.
That's one of the ways that I can say I know we're in a more normal market. In February and March, when these properties where everything was getting 20 plus offers, listing agents didn't pick up their phone. It's almost like we put it in the computer. I'm not talking to anyone until Tuesday, and we'll just let them all come in. And in that instance, we would record a video walkthrough of the qualifications, let them know we're available for any questions, call, text, email. But what I can say is it's been a lot easier to get listing agents on the phone. And they're not saying, hey, we have no offers. They're saying, hey, we got 5, 6, 7 offers here, and we're trying to figure out who's the best. And I appreciate you giving me a call.
No, and even with all that craziness going on, you got DAR was here saying that used a USDA loan, which allows you to buy at 100% financing. They offered $100,000. No, they offered $1,000 over the asking, got it accepted, got the repairs, done, and painting and replacing carpet. So it does happen. That's in Connecticut. Clearly going to be different in your, depending on your market, but it's not all craziness out there. Now, I read this question earlier and I had to laugh a little bit because I've actually seen this happen. In fact, Josh has been into a property that had this that I was selling. And so, serious question. I can't tell you how many great houses I've seen that reeked in cat piss. What could a potential buyer do to alleviate the problem? Contingent offer. Have I faced this as an agent? I've faced it as selling a property before. And in the case that I had, it was a flip property, right? It needed to be completely gutted. And it not only smelled like cat piss, it smelled like smoke and everything else. And honestly, that there's products out there that supposedly get rid of the smell and all of that, but a lot of times that stuff seeps it goes through the carpet, into the padding, into the wood, and you can't get rid of it unless you actually rip the wood out in some of this stuff. And depending on the situation, if the cats are peeing on the drywall on the side, you might have to get rid of that as well. I mean, it's definitely a big issue. But you're saying, contingent offer, in that sort of situation, you have to understand the cost that's involved to remove that. And, if you're going to make an offer, just know that if you're going to do anything about waiving anything, that you understand that, this isn't HGTV where you pay a couple $100 and the smell's gone. This is going to cost you some big money in a lot of cases to get rid of that. Josh, anything you want to add to that?
No, if you remember in that instance, that condo that you had listed, we brought in my contractor on that, and he's like, "Bro, no way. That's not. It's not a paint over it. It's not a put a kills over it. It's not put some stuff on the concrete. So it probably was a concrete slab upstairs. Had a wood subfloor, and it was everywhere. He's like, you're probably going to be $5,000 to $10,000 into getting that smell out of it. And what was that thing? Maybe a 900 square foot condo."
Yeah, probably 9 something. Yeah. But somebody ended up buying it, flipping it, and they timed the market well, and did well on the resell of it. But if you're buying it as your primary, just understand that there's a lot that goes in there, and there's a lot that could go wrong in that sort of environment. RK has a question about, can slowing down in housing market be attributed to summer months and not crash correction as everyone portraying it to be? Can you share data about drop in sales March to July year over year? Thank you. So absolutely. Could it be? For sure. I think there's a couple of different factors going on here, and it's hard to pinpoint exactly what's happening, but you've got affordability becoming an issue in a lot of markets, right? So you're getting buyers just priced out of certain areas, and it's causing them to sit on the sidelines. You've got those that just sitting on the sidelines because they're unsure of where the market's going. So you've got that factor playing into it. You've got people now in the state of California, for example. State opened up mid-June. Per the state, it opened up. And so you got people now traveling on vacations. They want to get out of the house. They want to go do things other than sit at home. And people just don't want to search for property, in this sort of environment because they've been tied up all time. So I think that's a factor. I do believe that it is an issue, or it's playing a part in the numbers that you're seeing out there with regards to demand. And then you also have people that just can't find a house. They've been looking for months, and the right property hasn't presented itself. I mean, I'm in contract right now with a buyer actually from YouTube here. And we went under contract a couple of weeks ago, and it was contingent upon the seller finding a replacement property. And they were actually in escrow on that property that they were going to close on. It fell apart because the seller on that side wouldn't agree to certain repairs. And so that seller is still trying to find a property. They're still trying to find something that meets what they're looking for. And it's been 2.5 weeks now, and they still haven't found anything. Now, I realize that's a short period of time, but there's just a lack of available property out there. And that's part of the reason that you're seeing numbers drop too, because people can't buy something that's not there. And so I think there's a lot of factors playing into it. And it's, I don't know that there's a clear cut answer at the moment. A lot of this stuff is viewed in hindsight. You're not really going to know what happens until 3 or 4 months from now. As I mentioned yesterday in a video, one of the lagging indicators that people reference a lot of times is mortgage applications, right? So mortgage applications started to decline back in December, and they declined for a couple of months in a row, and then we kind of saw a slowdown in the housing market. Now, did mortgage applications decline because people weren't interested in buying, or was it because of some of the other things that I just mentioned? It's hard to tell. Josh, anything you want to add to that?
No, to me, the interesting thing, or the more interesting thing, is what didn't make sense. And you have a better lens when you look back in retrospect. Like February, March, April was way more nuts than any of us expected. We can go back. We were doing these lives last fall, and we're like, no, the market's going to be strong, and we'll see another 5 to 10% appreciation next year. February and March come around, we're seeing 5%, 7% a month. You're like, what in the world is going on? And when you go back and you look at the number of sales that occurred March, April, May of last year, how many deals fell apart, how many homes got pulled off the market, never went on the market, you had 3 or 4 really low months. And those people didn't go away. Their lives and lifestyles didn't change to say, I didn't want to buy a home. We were all impacted by the pandemic. So when things were opened up by the end of the year, and especially January 1, New Year's resolutions, New Year, things are looking a little better, people just went nuts. So we had the same size door for everyone to go through, and we had twice as many people going through it. So when you look and you normalize it in that sense, it makes more sense. When we look at any numbers right now, you still don't have a lot of sellers coming on the market and making their homes available. If in any other time, no one would be portraying this as weakness. We have a lot of buyers. We have really good interest rates. It's weak relative to the insanity that we had of the early spring, and that's good for everyone. We've talked about this. It is not a healthy home market to see double-digit annual increases, and if it happens for more than a couple of years in a row, it does lead to a big correction. So hopefully we slow down and moderate. Even if we went down to a 3 or 4% appreciation pace year over year, that would be good for everyone.
I agree 1000%. Yeah, we could go down a rabbit hole on that whole thing, and I think it's better just to continue moving on, and we'll probably address it here in another question coming up. I'm sure of it. I actually skipped this question by accident and didn't mean to do it, Gilbert, but asking, is it a bad time to invest in the Newport Beach Peninsula? So here in Orange County, there's a city, Newport Beach. You guys have probably heard about it. And asked about investing in a property, using it as a second home, has a commercial front downstairs, asking what the going rate is. Unfortunately, don't know what the going rate is. It depends on where that property is located on the peninsula, and the size of it, what it could be used for, could really factor in a lot of that going rate. But as far as investing in it, Newport Beach, the peninsula, is one of those areas that, yeah, it might get hit if market goes down, but it's going to get hit less than most areas, just because of the amount of money that's there. And as markets correct and go back up, it's going to be the first to go back up. It's one of those markets that's going to remain strong because it's the beach, it's Newport. There's a lot of money floating around. It's great for investment purposes, but it has to make sense, right? We always talk about the numbers never lying. If you're going to use it as a potential investment property, see what, second home / investment property, see what kind of money it brings in, and based on your down payment, does it cash flow? Is your goal cash flow? Is it appreciation? What is the plan? And that'll help you determine the direction that you want to go. And then you go on to ask, I'll let you jump in a second, Josh, asking about, saying in the Central Valley, the '08 crash caused 50% plus reductions in your area, and wondering how the peninsula reacted. So you saw similar stuff in that market. I mean, not 50%, but you saw, a pretty good sizable difference in where properties were selling in, say, '05, '06 to, '09 or so. I mean, you saw 30% probably at least in some of those properties, but it was also the first to rebound, right? As the market rebounded, it was one of the, the areas that came out ahead the quickest. Now, Josh, you wanted to say something?
Yeah, I would just say with a property that has mixed use, that has a commercial element to it, the guidelines on that and the financing can be different. So depending on what you're thinking in terms of down payment and what financing is available, it would be something you would want to check into. And the numbers I always like to give people. So for my house here in Huntington, it peaked at just a hair over a million, and at the worst, it probably was a little under 800,000. So with that, a 23, 24, 25% decrease in value. My primary market for flipping homes was out in Anaheim. I have a lot of clients out in that area. I was very familiar with the homes. And the very first home we bought, and this is not a perfect example for a number of reasons, gentleman bought in 2006, late 2005 for $685,000. We bought it in October of 2008 for $265,000. So even when it was fixed and completely done up and perfect, we sold it for a hair under 400, like 395. So even if you say he bought an ugly house for 685, we sold that same house beautiful for 400. So the reality is it was probably a 685 to a 325, 350 for a normal sale of a home in decent condition. That's a 50% drop. So what you saw was lower income areas, less trophy areas. The Central Valley was really unique because there was shit tons of building through 2003, 2004, 2005. They built more homes than they had people wanting to live there. People were willing to move there to these outlying areas because they couldn't afford to buy where they really wanted to live. And once the market starts dipping, people go, I don't want to live out there, especially if the home values are dropping. So Newport's its own animal. And just like Jeb said, it dipped and it took a big and heavy dip, but nothing like what lesser areas did.
No, absolutely. I got a question here from Michael DeRee asking, when is it worth it to buy down points? He's apologizing because he knows that you've answered this a million times. But
well, should we just go with the easy answer and say never, or should we give the detailed answer?
The quick, detailed answer.
Well, here, we're going to show you this one. Let's go. Where did my screen go?
He's trying to be fancy now.
Well, we can be. It's technology. It's fancy. So this is a chart of mortgage rates, and we've talked about this before. This is 1981, Halloween 1981. We peaked there, and since that time, we've gone nowhere but down. When I say nowhere but down, they went down all the way through 83, and then up through 84, and then down through 86, and up through 87, 88. So they don't go directly down, but rates have done nothing but go down for 40 years. We've explained on the show here before why that's not going to change and why things aren't going to be getting any different. So what would happen is if you were to pay points, you're essentially buying down the interest rate. You're prepaying the interest. So the lender is saying, hey, we want X in interest yield over the life of the loan. If you want to pay less monthly, you can pay us points up front so that we get our interest. So you are prepaying that interest for them. You don't ever get a chance to get that back. If you do a 0-point loan and then we come back 2 years later and rates are a 0.5% lower, you get that 0.5% for free. You didn't have the sunk cost, you didn't pay the money up front. So until we see this trend here break and they're not going down, there's really no need to ever pay points. And most people are shocked at how little a 1 point or 2 point, and a point is a percentage of the loan amount. So if you're getting out a $400,000 loan, you want to pay 2 points. It'll generally get you about a 0.5% lower interest rate. It's going to cost you $8,000. So for that reason, we go through it with our clients that it rarely, if ever, makes sense. When does it make sense? If you have no other way of qualifying for the loan. Have we had to pay points to buy a rate down to get a borrower qualified for a refinance or in sometimes a purchase? Yeah, and if it's the only way to get the loan done and it's going to make you more money or save you more money over the long haul, that makes sense. But just to have a slightly lower monthly payment doesn't generally make sense until we see the end of this 40-year downtrend.
Yeah, and as Josh always says, the numbers never lie, right? So have a lender run the numbers for you, see what it's going to cost you, see what the savings are on your mortgage. How long is it going to take you to repay that, right? I mean, and are you going to be in the property in that period of time? I mean, that's what it boils down to. If it makes sense and you can repay it in a couple of years, great. If but the chances of rates going down, like Josh said, are likely are the probabilities higher And if you've got cost invested up front with buying down points, you're not going to be able to take advantage of those without potentially losing money. So that's the easy answer. Thank you, Josh. Jesse has a question asking about update on First Time Homebuyer Act. No updates that I'm aware of at this point. I don't think you're likely to see anything on the front with regards to this anytime soon. Just too much going on in the housing market at the moment. If things were to slow down at all, I think it could become a topic of conversation again. But at the moment, not a lot happening on that front. If a rate lock expires, Josh, because of a builder, who pays for extending it?
Believe this falls back to Jeb's favorite thing, the 150-page contract that you sign with a builder versus the 8 to 12 or 15-page contract you sign with a realtor. It generally spells out in there almost every possibility for a future dispute or a lawsuit. So it probably tells you in there what happens. If you could prove without a doubt that it was 100% their fault and was avoidable, but they put legalese in those contracts that basically says this is a target, not a fixed date set in stone in terms of a closing date. So for the most part, you're going to end up being responsible for it. Now, if they tell you, hey, we're going to be done in 20 days, you can go ahead and lock now, and you get to day 20 and it's not ready and it's going to be ready in 5 days, they'll generally work with you. This is another one of the reasons why they always want to tell you, well, use our lender, and we'll be more flexible and helpful with that. Just remember, you're paying more for the most part for using their lender, which is sometimes offset with credits for design center upgrades, that type of stuff.
Yeah, and like Josh said, I mean, if we're being completely transparent here, I mean, if you're using their lender, it's more likely to probably be covered by the buyer, but you're also, like you just mentioned, likely paying for it in a higher rate anyway. So is it really a good deal? That's what you got to weigh. Hopefully, your lender, I know back in the day, I don't know, Josh, you can talk about this. If a lender needed a short extension, sometimes they were able to get a couple of days for free. Is that still the case, or are you paying for every extension at this point?
Hopefully you have a good relationship with the lender and do a volume of business with them. If you can show that the delay was on their part, somehow they messed up and didn't get a closing disclosure out, they will cover that 8 days a week. We have a file right now that was complex. Appraisal got delayed, and I think it was 2 refinances for one borrower, and I think we ended up needing 7 days on both of them. And the lender worked with us. They like our business. We do a lot of business with them. So it comes down to the relationship and oftentimes just whose fault it is. If it's clearly their fault, most lenders will cover a day or 2 or 3 or 5.
All right, there you go. Guys, if you are watching right now, haven't hit the like button, do that for us. It's the only thing we ask of the show. We're not here promoting anything or asking for anything other than you guys to, like it. And if you appreciate it, we appreciate you being here and doing that for us. So let's see here. We got a question. So Kathy May says, I signed a purchase agreement based on seller's request 3 days ago with contingencies. Last night, seller wasn't happy with the contract anymore and wants to close sooner. What should I do? If you're in a position to potentially close sooner, then maybe you consider it. But I mean, since you've got a contract and it's executed, I think you're probably good with regards to what's in there. I mean, I think there's some information maybe missing there. A little bit more detail would allow a better answer from me. But it sounds like, I mean, if you've got an executed contract, then it really, I mean, then your timeframes are what's in stone, so to speak. But if they want to close sooner and you're okay closing sooner, then maybe that allows you a benefit of a shorter lock or some, maybe other benefits. So just, weigh your options and see what works best for you, because at the end of the day, it's, that this is a situation where you do what works best for you since you're in contract, right? You've got a little bit of leverage on that side. Dar was here. So another question here for you, Josh. Do letters of explanation really help in underwriting? I had to write a few. So you spoke on this earlier, and you mentioned that they do, so they don't have to read between the lines. But anything else there?
Sometimes they're required. So let's say we put no letters of explanation in the file and just send it to the underwriter. The underwriter has a question and they want to hear from you. So they say, what happened with these mortgage lates 2 years ago? What happened with this IRS lien? Any number of things they could want explained. Hey, what happened? You were off of work for 3 months between the last two jobs last year. They're generally, if they're asking for a letter of explanation, they're going to approve the loan. They just want something in the file that explains what happened there above and beyond the loan application. Loan application has no space for any narrative explanation of anything that may have happened in your life. So oftentimes the underwriter is going to ask for it if the file doesn't make sense ahead of time. So for us, we're trying to anticipate and see what they may have a question on, because if we can prevent them from asking it in the first place, it's better for everyone involved.
No, absolutely. We had we got some good questions coming in. This is a good question and one that I don't know that we've been asked, but it's something that I think people probably often wonder. If you have a primary residence, you decide to rent it out after a year, do you need to let anyone know, Josh?
You do not. They're going to find out most likely because they get a copy of your insurance policy. If you have a mortgage, you're required to have insurance, and they can see that it switches to a landlord's policy. If you don't make the switch, they can generally see that the mailing address for you has changed there. So there's ways for them to find out, but there's really nothing that changes contractually with you. You signed an occupancy affidavit that says you are going to occupy the home as your primary residence within 60 days of closing. You didn't say, I'm going to occupy this as my primary residence for the rest of my life. So if you're a year into it and life has changed and you need to move somewhere else, you're perfectly well within your rights. You do not need to notify them, but they will probably find out regardless.
There you go. I like it. Jasmine she finally made it, saying she loves the channel. This is self-grandizing, so I thought I would post it. Why not?
So your wife made a burner account?
Yeah, exactly. Yeah. That's what I call our home, Jasmine. You had no idea, did you? No, thank you, Jasmine, for being here. Judy's got a question, another good question. So I'm projected to close on 7/27. It may be earlier. I have a month-to-month lease. When should I give my landlord notice? Now, this is one of those conversations I have with buyers when they're going through the process, because once people go into contract, the first thing they want to do is call their landlord and say, you know what, I'm done. I'm under contract. I'm leaving. Not the right move, in my opinion. I say you don't tell anybody that you're leaving until all contingencies have been released. Now, that means you're going to be paying for both places for, a little bit of overlap there for a period of time, but security is important, and in the security in knowing that you've got a place to live, because sometimes if you let that landlord know, they might go out and try to find another tenant for that property, and say they do, and your deal falls apart. Now you're in a position where you have to go find another property. You have to find a lease that'll allow a month-to-month rental if you want to continue searching for a house. You also have to potentially move twice in those situations. So paying a little bit of money to live or have two different things going at the same time, in my opinion, is worth it to know that you're not going to be homeless if something does go wrong. You have some agents that might tell you as soon as you go under contract, then that's the time. I say wait till you have certainty that you're moving forward before you make that move.
And it may be a little conservative, but I'm 100% with you, Jeb. The most stressed out buyers that I see are the ones that gave notice early, and there's a lot of stress. There's a little bit of cost in having the overlap, like you said, but it's well worth it in peace of mind. And those are the transactions that seem to go smoothly. Paradoxically, the people that give their notice early are the ones that seem to run into issues.
Yeah, I mean, think of the situation where you go into escrow on, say, day one, and I know we're beating this to death, but just let's do a little example. You go into escrow day one, you let your landlord know, hey, in 30 days I'm out. Well, what happens when escrow gets extended a week or a week and a half because something goes wrong in the transaction or whatever, regardless of whose fault it is? And now the landlord says, you know what, you've got to be out on that day. Now you've got a 6-day gap that you got to figure. I mean, there's too much risk involved, in my opinion, to not pay a little bit more money. And if you can't afford the little bit that it costs, then do you really need to be purchasing a house, would be the question that I ask. Jimmy Wynn has a question here. What is a second deed of trust? trust. My wife's mom is offering to loan us a 20% down payment on a house as a second deed of trust. Josh, and can you do a second deed of trust, as a loan from a family member?
You can. So just to start with the first part of the question is, what is it? So depending on where you are in the country, when you get your loan, it is secured against the property either by a mortgage or a deed of trust. So you're most likely here in California or another deed of trust state. And that is what actually secures the loan to the property. When you sign the note, it says, I owe you X dollars at this much interest over this period of time. So that creates the debt. The deed of trust secures the debt to the loan, and it gives the lender the ability to foreclose and take the property back if you don't meet the terms of the note, of the loan agreement. So what she's saying is, I'll loan you the money, but we're going to do it as a second deed of trust. And all that means is it's recorded in a second position. The lender on the first gets to record first, so they have priority lien position. This is a second deed of trust that goes behind it, meaning that if you ever defaulted, she would have to bring the lender on the first current and make them whole if she wanted to foreclose. Otherwise, she can walk away from her money, and the lender on the first can do the foreclosure, and she doesn't get anything. So it's a riskier position than a first deed of trust. Jeb asked the absolute right question here is, will the lender allow it? They will generally allow it. Doesn't necessarily matter that it's from a family member. There's some requirements in there that it generally needs to be at a market rate of interest. If they're going to do 0% interest, a lot of times lenders aren't okay with that for whatever reason. So just go through with your lender. I'm assuming you're going to do a conventional loan. It wouldn't make a lot of sense to do an FHA loan that has mortgage insurance regardless of the down payment if you had a 20% down payment. So this would be helpful in enabling you to come in with little to no money down and not have mortgage insurance and still get pretty good terms on that first. But absolutely check with the lender you're getting pre-approved with or have been pre-approved with, and make sure that it fits and that the lender is okay with a 100% combined loan to value. Because what that means is you're getting an 80% first, your family member is giving you the 20% down, but now you have 100% loan to value between those two loans. That would be my biggest question, is if the loan program allows 100% loan to value or if they require a down payment from you.
Now, Josh, I have to apologize because I was completely doing something else during that conversation, but or during the response there. Now, did you mention, like, if there is an interest rate on that loan, that the lender's going to qualify you based on the payment that you have to repay for that? Is that part of the qualification there?
Absolutely. It's not just because you're making the payment to someone else doesn't mean they don't take it into account. They'll take the interest rate, they'll take the loan amount, they'll take the loan term, and they will qualify you based off of that payment. Now, again, depending on the type of first mortgage, there's going to be guidelines. Can it be an interest-only payment? Maybe. Can it have a balloon payment in 5 years or 10 years when the home's gone up in value? Probably. But those are the details that you want to go through with your mother-in-law, or is it your mother-in-law, of what she wants to do.
Did you
And
just
then
burp, bro?
I apologize. I'm going to have to stop drinking seltzer while we're answering questions. This was your turn to answer, and you made me go back. So yeah, you're looking at that of you're going to have to qualify for it, and they're going to want to know what your mother-in-law expects as repayment and how we're going to qualify it.
All right. And Michael Dury is following up to my no running or never, he never runs earlier, and says, you run to the fridge to get a beer, right, Josh?
Of course.
And then Gerald, he's laughing, because I'm a regular comedian here, just making jokes. It all makes sense. And people recognize it, Josh. And that's,
I trained the dog to run to the fridge to get the beer.
You wish. All right. Tesla has a statement here, a comment that I think is worth mentioning. Had no clue that buyers were making cash offers than getting a conventional loan. A realtor told them that. Yeah. So in some cases, people are doing cash offers up front to make sure, they're competitive in their offer, and then they go back and get a loan after the fact, versus coming in with the loan up front. So if you have the cash, the ability to do that, that's one approach. But when you go and pull property, money out of the property, you're doing a cash out refinance of that at that time. And depending on how much you're pulling out, may get you a much higher rate than it would have been just to go in and do a loan up front. So you got to weigh the cost and the rate, the monthly payment, and see if that makes sense in that situation. Let's see here. Richard said the same thing. Uh, all right. Let's see. J. Roar was involved in a car accident and on disability. So sorry to hear about that. Any way for someone to buy a home on disability, Josh?
Depends on if it's temporary or permanent disability. So what a lender's looking for in income for qualifying you is to know that it's going to continue for 3 years or more. So if the car accident has you on temporary disability and it's sort of undetermined how long you're going to be tied up or unable to work, it can be really hard. Generally need that to be permanent disability. Permanent disability income is no different than any other income, and we use it all the time to qualify. So really it just comes down to what we can document about the continuance of that disability income.
All right. I thought it was 2 years, so it's 3 years. What kind of things can go wrong if you accept the entire year's rental payment upfront from a renter? Also, would you use that upfront money as a down payment on another property? So I think there's less things that can go wrong by accepting it upfront. For a year lease, I don't really see any things that can go wrong outside of what could normally go wrong with having a renter in a property during that time frame, because you're getting all the money up front. So there's some security there that to know that you're not going to have people not making their payments. And you're asking, would you use that money as a down payment on another property? You have to see if that makes sense, right? I mean, have a lender determine if that makes sense for you. Are you in a position to make that mortgage payment on both of those properties? You just gotta weigh all the options there. I don't know that there's a straightforward answer on this without going through all the scenarios and just making sure it makes sense for your situation. Let's see.
I had a good one here that comes up often, and I don't know if we've answered it here on the show. Jeb, is there a huge disadvantage for using an escrow impound account for taxes when paying a mortgage? Putting 20% down and I have the option to just pay the taxes myself. Pros, cons?
I don't think there's a huge disadvantage for using an escrow account. I use one because I don't want to get a tax bill every year asking me for a large chunk of change. I'd rather just pay it as part of my mortgage and it goes away. I don't have to think about it. And that money sitting in my checking account is going to earn what point zero zero
Zero,
zero
zero,
zero.
one.
1%. I mean, I'm not going to earn really any money on it. So for me, it makes sense. You have people that think the other way. And say, they want control of those funds. They might want to invest them. They might want to do something else with them, or they might just want the cash on hand just because, cash is king and you never know what's going to happen. And just having that cash available gives them security for whatever reason. And so some people want that and decide to pay their property taxes twice a year. That's how it's done here in California. So that would be the pro, is that you have the cash and you could do other things with it. But the con would be that you're going to get those, that tax bill at some point, and you're going to have to pay those property taxes in a lump sum. So for me, I just like paying them as part of my mortgage, and I don't have to think about it outside of that. Go ahead, Jeff.
The only positive to it, we get this one all the time. I get calls. Hey, you did my loan. You did my purchase loan last year. You did my refi last year. I just got a notification that my payment's going up $120 a month. What happened? Well, the escrow impound account, they're allowed to have a cushion for both the taxes and the insurance in there. And what they do is once a year, they do an analysis. And if they have too little money, they're going to increase your payment for the next year to make it up, or offer you the opportunity to pay it in one lump. And the flip side is, if you have too much in there, which I think I've had this happen once in 25 years of homeownership, had a refund back of a little bit of money where they had too much in the account. So you can avoid that. But like Jeb said, when I moved out of my first condo and we bought our house, I was like, these taxes are actually high. This is real money. I'm not going to give it to them. I'll keep it and I'll make the payments myself. About 2 years later, we bought in 2003, and in 2004, 2005, we refinanced. And when we refied, I was happy to add the impound accounts and not have to deal with remembering to write the damn check. I wasn't accounting for this. I mean, it's coming, it's there, but it's a lot of money. It's not fun to write a big check. So I'm like Jeb. I include in all of my properties, have it impounded and just include it in the monthly payment, so I don't have to think about it and remember it.
And what I would say that I didn't mention a moment ago is not having that account allows you to make, I mean, it's going to be a lower monthly payment, right? So it allows you to pay less every month. So that could be a pro depending on your financial position. I mean, if you're in a commission only job and your, money isn't regular for whatever reason, it just allows you to budget a little bit differently. But I would say that another con to doing that is that when those taxes are due, they're due. And the penalties, at least here in the state of California, are huge. I mean, it's so many days. If you don't pay it, it's a big percentage. And then after that, there's another percentage and it continues to escalate over time. So just know if you're not paying them, you're going to end up owing a lot more down the road, by going that route. So, Busen, Busen biased. How do I buy a home I know isn't on the market yet? Sellers wanting to buy a new residence first. That's a tough one. If you know the agent, then contact the agent and see if there's a way to do it. Go knock on the door, of the property and tell them that you're aware that they were potentially interested in selling the property. Tell them you want to buy it. Try to make it happen. I mean, off-market deals happen all the time, and if your offer is strong, that might put them in a better position to buy the next property. In some cases, sellers don't want to deal with buyers, with selling a home not on the market. So you might get someone that's not interested in doing that. But the best approach is to either find out who the agent is and try to have that conversation, and or just go to the seller directly and try to have that conversation. And then they might just refer you back to their agent anyway. But outside of that, there's no real secret to being able to put that together, at least that I'm aware of.
We've got a couple good ones here. Joey keeps wanting us to display that silly picture of John Elway getting destroyed on that tackle. But he says, have either of you gentlemen seen any recent deals close or accepted below value, or is that not within the bounds of this market? And let me start with my anecdotal experience, Jeb, and then you tell me what you're seeing. Mm-hmm. Anything that's priced right in our market is going to sell in the first weekend. Maybe it's 7-8 days before it goes pending, but they're accepting offers, reviewing, going back and forth and countering. The things that you're seeing, if something's been on the market for 30 days, it's not priced right. So when you see something that does sell for less than asking or has had a price reduction, it's generally because we had a super aggressive seller. In my neighborhood, we had a home that was a large lot, recently renovated, largest model in our neighborhood, and it sold for a really nice number. The wizard 2 doors down decided he wanted only $100,000 less, despite the fact that he was 500 square feet smaller, didn't have the big backyard, didn't have the pool, and didn't have any of the upgrades. And 45 days later, he's still sitting there thinking he's going to get $1.4 million for his house. But for the most part, if it's priced right, it's going fast. Now, I'm not saying all real estate is local. It may not be that way everywhere, but everything that I'm seeing in Southern California, if a home is priced right, they're getting multiple offers and selling in the first 7 to 10 days.
Yeah, when I read that question, what I read is anything being accepted below value, and my answer is no, not below what it's worth, right? I mean, I think anything in this market that is selling pretty much to what it's worth. If it's not selling, then it's overpriced, like Josh mentioned. So as the price comes down to be more reasonable, then the property's maybe getting offers and going under contract at that point. But I'm not really seeing anything that I would consider, a seller getting a deal in this environment just because of how competitive it is. In some cases, you have, heirs selling property, when there's a trust sale or a probate deal or, a flip opportunity. In some of those cases, there are deals happening in the market, but they're few and far between. And, and chances are, if it goes to the market, there's going to be competition and drive that price up to the fair market value. But, not really, not at this time. As we start to see that sort of thing change, obviously I'll be talking more about it on videos just to keep everybody in the loop and so that people know what's going on. I mean, the whole goal here is to keep you guys educated on everything that's going on so that you can make educated, informed offers, decisions, and what have you. And at this time, we're not seeing a lot of that.
Well, it goes back to, Jeb, the definition of value. We keep having as well, I'm not going to pay more than the home is worth if it doesn't appraise. The value is determined by the market. So when we're saying that anything priced reasonably is getting multiple offers and selling in 7 to 10 days, that's the market speaking. Multiple buyers in the market are saying, I'll offer this. The seller entertains them all and decides which they're willing to accept. That is the market value. So no rational seller would take less than the market value. And even that person that overprices, if they're serious about selling and they eventually sell, my neighbor, he wants 1.4, he eventually takes 1.27, which is probably what it's worth in the current market. Did he give it up for less than value? No, the market determined the value for him.
Right. No, that's good. Michael DeRee is asking a question. What's a typical commission for a real estate agent in your state? Not really going to get into commissions here. It's one of those things. There's no standard. There's no typical out there. It puts me in a tough position to talk about commissions just based on the restrictions out there and that sort of thing. So don't want to get it, talk about it on the internet just because it's one of those things that could get me violated, violations and what have you. So we're going to move past it, but it's a good question. But in the state of California, it varies, right? I mean, you got some that pay what people have traditionally seen, and you have some selling for much less all the way around. So just use your imagination there, and hopefully that get you a better idea of where things are going. Drive NYC is asking, looking to rent out primary residence to purchase another property. Will banks still count first mortgage in the DTI, or will it be like starting fresh? So if I own a property, Josh, I'm renting it out. Maybe it's not even rented yet. I plan to rent it out, and I'm going to buy another property. How will the lender use the rents and what I currently pay on the mortgage in order to qualify me?
So what they refer to your primary residence that you're leaving is a departing residence. So if we're departing a residence and converting it to a rental, we don't have a history of the vacancy rate, maintenance, any of the expenses. So they're going to use a 25% vacancy and expense factor, and they'll give you 75% of the rents. And they use that 75% of the rents to offset the payment. So you're not going to have to qualify for the entire payment. So using a super simple example, let's say you have a $2,000 mortgage payment. You go, I'm cool. I can get $2,000 a month in rent. It's a wash. It's a wash for you as long as you collect that every month and you don't have any expenses. But from the lender's perspective, they're going to give you 75% of that, or $1,500, and they're going to say $2,000 mortgage, $1,500 net rent. We have a $500 loss, and that's treated no different than any other monthly ongoing obligation, like having a $500 car payment that you would then qualify with. And on the flip side, if it rents for $3,000 a month, 75% is $2,250. They'll take the extra $250 above and beyond the $2,000 mortgage payment and give you $250 of additional rent to qualify with. So if it's a loss, it gets treated as a recurring debt. If it's a profit, it gets added to your income for qualifying the debt to income.
All right, there you go. Gerald's got a question here. What's the difference between a condo and single family detached condo? Ran into this question on property type shopping homeowners insurance. My purchase agreement says single family detached condo, but insured as HO3. So the big difference in insurance policies are going to be what the insurance policy covers, right? If you're buying a condo and the association only covers the exterior, you're going to have to get an insurance policy that covers the interior of that property. If it were to burn down, something were to happen to it, how's it going to be rebuilt? That is what HO6 insurance, Josh.
Then HO6 is walls in.
And then if you have a condo association that covers the entire exterior and the interior of the property, that's going to be a different type of insurance policy. Is that HO3 or what is that one? I don't know what HO3 is.
The HO3 is your standard policy, like you have on a single family.
Got it. Okay.
It includes walls in.
Got it. So you just gotta it's based on what the insurance company covers. That's the big difference there. So it sounds like if you got HO3, then the association's covering everything, including the walls in, which is a good thing. But you're paying for it in your dues. Anyway, we move along here to Joey. Joey just likes to see his face come up. Thanks for the insight, gents. Value was a poor choice of words. I meant lower than ask, but you guys got it. Salute. Thank you, Joey, for being here. Appreciate the support as always. If you guys haven't hit that like button.
in lieu of the super chats, I am just requesting a new profile picture for Joey that doesn't involve John Elway or ugly Bronco gloves.
I actually appreciate the super chat. So you can when Josh finally gets his YouTube channel going,
you don't
and
give him
you
up.
show up over there,
you don't share.
then he can decide what he wants to do at that time. Right.
Hey, we got a good one here that you'll
all right,
like.
let's see it.
So Jay Girl says, starting to see quite a bit of back on the market here in Washington. What is the most common reason? For the most part, if you're seeing a lot of it, I would say it's anecdotal. It can just happen in any area, more common. But what do you see as the biggest reasons besides financing problems for the buyers being reasons for homes coming back on the market?
It could be a number of reasons, right? A lot of times agents will tell in the agent remarks why a property fell out of escrow just to let other agents know. But buyers get cold feet in some cases, right? They get into the property. They realize, you know what, this is the biggest purchase I've ever, the biggest transaction of my life. They get scared. And that happens often, guys. It's, that whole idea of buyer's remorse. And it doesn't even mean that you have to close on it. Just getting your contract accepted, people get emotional, wishy-washy, if you will. And sometimes that can be the reason. Like Josh said, financing can be a reason that it falls out. You could have a home inspection, an appraisal that is less than the value of the property, and the seller's not willing to negotiate. Repairs, the seller's not willing to negotiate. Right now, there's a lot of, if I'm being honest, a lot of unreasonable sellers in this market for many reasons. And a lot of times it's their agent, if we're being completely honest, kind of pushing their agenda in some ways and help, and helping, and I say help, using that word lightly, them make decisions and think that they have leverage, and deals fall apart for that. So it's hard to say why deals fall apart. If it were happening all the time, all over the place, then maybe there's something to look at. But 4 or 5 in a sample market of Washington, I think you're in a pretty busy area. If I remember correctly, it's probably not much to pay attention to. But another thing is you can call the agent and ask, well, the deal was in escrow. Why? Have your agent find out why it fell out of escrow. I always ask, if a property was in escrow, what happened? And the agent's obviously going to tell you and not necessarily tell you the truth in some cases. But if it's something related to a home inspection or appraisal, chances are they're going to be upfront. But a lot of times it's just people getting cold feet.
Or not qualifying. We had an agent reach out today. They're 7 days away from qualifying. The lender told them absolutely no problem, and it was a VA deal, and found out that the buyers they're either not VA eligible due to being as a member of the reserve, or the records are not available to find that out. So legwork that should have been done long before offers were written was not done, and the buyer and the agent are in trouble because of that. So there's a lot of reasons: financing issues, appraisal, and property inspection issues, probably the 3 biggest ones, right?
Well, yeah, and I'll reference back, to the property that I mentioned earlier, where my client is in escrow to buy a property, but is contingent on the seller finding a replacement property. As I mentioned, that seller was in escrow on a replacement property, and once their deal fell apart on that side, they came back to us and said, "Hey, listen, we need more time to find a replacement home." And my buyer was going to cancel. Right? If that had happened, that property would have gone back to the market. It would have been an active listing again. And so that could be another reason, right? You just never know the reason why things go back to the market. So I would tell you, don't start thinking that the market's changing just because, you see a home come back on the market. There's a lot of reasons why things can go back up on the market. And I'm going to start over. I can't talk tonight. And sometimes agents just pull them off the market to put them on hold. So you never know what the status was, right? If it goes from active to pending and then back on, that's one thing. But if it goes just off the market and comes back on, an agent could have pulled it off for a number of reasons. Maybe the seller didn't want to show it for a period of time. They had something else going on. Just, again, have your agent try to find out, and that'll give you a little more clarity if it's something you're interested in.
Here's another one for you, Jeb. What are your thoughts on this? Bassam Rajeb says, "Hi, I live in LA. I have been looking for a house in Orange County. Do I still have a good chance? Is it okay to put 5% down as a first-time buyer? My agent is saying I can't put less than 10% down." Obviously, you can in terms of financing, unless it's a jumbo loan. But assuming that the financing is not an option, you could do it 5 or 10%. I've had several clients come to me and saying, "My agent says if I don't put 10% down, we can't get an offer accepted."
Yeah, so I'm not going to talk to you when I answer this question, but if Josh asked me that question, I would say, Josh, find a new agent. But I can't give you advice since you have an agent. But there's people getting deals at 5% down all the time. Is it going to be a little bit more difficult? Sure, it probably is, depending on where you're looking, how competitive it is. But make sure there's all the boxes are being checked. And I've talked about that in other videos. A 5% offer isn't a bad offer. You just need to somebody on your side that can convey to the other side how well qualified you are and put the deal together. But to answer the question, you do not need 10% down. Even here in Orange County, 5% down could get you in a property. And so, yeah, I'll leave it at that.
And if you have the 10% down, if you would prefer to put 5% down, so if you come and you tell me that, I get you approved and we're going to go shop with Jeb and say, Jeb, he only wants to do 5%, but he has 10%. Let's document it. Let's show proof of funds. Because again, one of the biggest things to sellers is they're worried it's going to appraise low and you can't make up the difference. So right. We just want to highlight the fact that the preference is to do 5% down. There's more available if there's a shortage, right. And it means the difference between getting this house and not getting this house. At the end of the day, the seller doesn't care what your down payment is from the perspective of, if you put 5% down, they get the other 95% from the bank. If you put 10% down, they get the other 90% from the bank. They're getting the same amount either way. They're just trying to make a decision among multiple offers, which is most likely to close and put the money in their bank account.
All right. No, a great explanation. And again, I don't want to say what I want to say, but I'm not going to say what I want to say.
I say do it.
Yeah, now. So Nightbot is saying, please make sure you hit the like button and subscribe to the channel. So guys, if you're watching right now, I only asked this a couple times during the show, but hit the like button. It helps people see the content. It's the only thing we ask here, with providing you 2 hours of good, ad-free information and helping you guys through a crazy market.
I have a question. Why isn't Nightbot threatening anyone tonight?
People are behaving.
He's been really passive. I just want him to threaten people regardless. People behaving, getting threatened for no reason.
Well, tell somebody just to throw some emojis in that comment down there. We'll see him go to work. Let's see. Ray Campos is saying, who's taking the NBA final, Josh?
Love me some CP3. If Giannis was 100% healthy, I go Bucks. But as it sits, I got to say CP3 is going to get his ring.
There you go.
And finally be acknowledged as a top 5 NBA point guard of all time.
There you go. All right. Good stuff. Amanda Womack, buying new construction, close of escrow date is tentatively December 15th. Lender is pressuring me to lock now. Should I lock now at 3.5%? I have a 790 credit score and 5% down conventional.
Can I say it?
Yeah.
Find a new lender. Find a new lender. There's so many elements of dumb in that that I don't have words for it. 12/15. So we are 5.5 months away from closing. We are at a low in the 10-year treasury for the year, and every amount of technical analysis on mortgage bonds says rates are going to go lower. So you're paying a monstrous premium for a 5.5 month lock. For what? So that the loan officer can feel comfortable. Generally, that length of a lock will require an upfront fee that you do not get back. They'll tell you, oh, if it goes down, we'll let you float down, but you're still paying that upfront fee. Most likely, if I were to guess, that is them wanting to collect that upfront fee, so they're not worried about you shopping for the next 5.5 months. 3.5% on a 5% down with 790 FICO is an awful interest rate. So, and it's awful, but it may be the correct rate for 5.5 month lock. That's why we don't do 5.5 month locks. So again, get another lender, get another opinion. If it's the builder's lender, I don't know. There's just so much that's crazy in that. Ask them why. Why would we lock now? I see that the 10-year is at a low since February. Why would we look at locking that now?
And record that conversation and then come back and let's
Yes,
play it.
let us play it. That would be fantastic. I expect a lot of stuttering and stammering when you throw that one out there.
Good stuff. Gabe just came back and said, lock at 3.5% question mark. I just locked at 2.25%. So, I mean, if people are getting rates down in the low twos, it doesn't make sense to refinance at 3.5%. But based on what Josh said, it doesn't make sense either way. Richard's got a good question here. How do we know when a seller's counter with a higher number is accurate? Was told for a house needed to come over 1.08 to beat the current highest, but when it finally sold, it sold for $1 million, just 1.012. So you don't really. I mean, that's the thing is agents are supposed to be ethical, or supposed to not lie and do the right thing. When I say supposed to, I know there's people out there that don't follow that principle and say they have multiple offers when they don't, and so on and so forth. I don't operate like that. I'm completely transparent in that regard. I have, no reason to lie in order to put a deal together, right? I'm trying to do the best for the seller, but I'm not going to lie in order to make that happen. But in a counter offer, right, most cases people are either asking for a highest and best, or they're asking for an amount to come back to. And so if they're asking for a higher amount, that doesn't necessarily mean they have another offer. But in your case, it sounds like they told you that. You never know. When something closes, like you mentioned, repairs, concessions, that sort of thing, that should be mentioned in the remarks on the MLS. The agents can see that, and they can see what was associated with closing that with regards to repairs, any work that was needed, and what have you. And you may be able to justify it there. But outside of that, there's no real way to prove it otherwise. So that's a difficult one. You just kind of have to take things at face value for the most part. And in this environment, that's hard to do. I can understand that.
And Jeb, even in a multiple counteroffer situation, those aren't identical multiple counters. They don't have to go back and say highest and best. They can go back to Jeb and say, Jeb can have it for $1 million. We don't like Josh. Josh, if you want to pay 1.1 million, we'll give it to you. I mean, it's a little absurd, but they truly can. If there's something they like about another offer versus another, they might be willing to push a lesser offer to a higher number. Say, well, I would be willing to go with a less qualified buyer if I got my number. So Richard, I mean, you've been here every week. I'm sure that's not your situation, but it's important to know that those multiple counters don't have to be identical. They can make 10 counters to 10 different people with 10 different numbers on them.
Yeah, and understand, like, for example, take an offer that's an $800,000 cash offer, and then you have somebody that did a loan at $850,000, right? They might go back to that cash offer and say, hey, listen, are you willing to offer $850,000 because we have an offer there, but it's not cash, and we want to accept the cash offer. So there's reasons that they could be doing that. But to answer your question, there's no real way to know if it's accurate or not, just based on just someone telling you. Unfortunately, there's no follow up on that. Let's see. Go ahead.
No.
Say something. Yeah.
Yeah. No, I've got one here when you're done with this.
Yeah. So Gabe is asked. Oh, he's saying, okay, never mind. He's just commenting on that. So I'm going to move along here. So go ahead there, Josh. Put it up.
Yeah.
There.
So the thrifty food scientist says locked yesterday at 3% with $2,500 in closing credits. Not sure if it was the right decision, but the difference between the lower rate was just $27 a month. So the numbers made sense. What do you think? So it goes back to Michael's question earlier of when do you pay points? So this is the opposite. To take a 3% interest rate, they were given a credit of $2,500. Probably could have gone the other direction and said you can get 2.875 or 2.75 if you want to pay $2,500. So this number works really well because on a purchase, it doesn't say whether this is a purchase or a refi. On a purchase, your closing costs are higher. On a refinance, we've negotiated rock bottom prices with our escrow and title vendors. Oftentimes you'll get an appraisal waiver. But when you have higher closing costs, this 3% is a great rate. No two ways about it. 3% is a great rate. Is it the absolute best rate out there? No, but you got $2,500 so that you're coming in with less money to close. When we believe that rates in 1 year, 2 years, 5 years, somewhere in the near term future are going to be lower, take the free money from the lender. It's a $27 difference a month. That's a 100-month break even or close to it before you even factor in the tax benefits of the higher interest rate. So when you say that, it truly is just a numbers game, and different people can answer the same question a different way because they all have their own lens through that they look at everything through. But it's important that you're working with someone that can lay out all the options, explain to you the pros and cons of each one, and one of those numbers will speak to you. You'll say, "Oh, I like that. I want the lender credit." Or you might say, "You know what? I don't like money in the bank. I'm going to give it to the lender so I can have a $27 lower monthly payment."
No. Yeah, that's yeah. Yeah. I'm reading too much going on here at the same time, trying to find the right question here. But appreciate the explanation there, Josh. I took a year-long break from work and started working since April last year. I have a stable job. Is it too early for me to apply for a loan? So I've been working since April of last year. So a year and what, 3 months, 2 months? Can you use that?
For most loans, we need 6 months or more back on the job. Where it can be problematic, if it's a salaried job or you get $50 an hour or you make $80,000 a year, no problem whatsoever. If you went back to that job last April and it's $20 an hour with significant commissions, bonuses, that type of stuff can be problematic. But like you said, we're over a year now. We're closing in on a year and a half. By the end of the year, even with variable income, you absolutely could. But if you have fixed income like a salary or an hourly wage, for the most part, after 6 months back on the job, a well-qualified borrower will be fine. We will still need a 2-year work history. So you needed to have, if you're back on the job for 7 months, we need a year and 5 months prior to that.
All right. Ahmad has a question here. I saw a house that I could tell belonged to a heavy smoker. How does a history of heavy cigarette smoke affect the price value of a home? So, it depends. In this environment, if somebody is willing to go in and paint and do what's necessary to get rid of it, probably going to not make that big of a difference overall. But you will have buyers that just aren't interested because of the smoke. So things like that, it just depends on how many buyers are interested in that property. You're going to lose some buyers. If there were 100 buyers that were interested in a property, for example, that kind of match the description of that one, you're going to lose a percentage of them when they go in and they find out there's heavy cigarette smoke. That's just the way it goes. But you'll also have some that says, you know what, I'm going to change the carpet, I'm going to paint, and so I don't really care. I'm going to do this anyway. It's not really a big deal to me. I'm willing to buy it as is. So it's really hard to say what percentage or how it's going to affect. It really boils down to the type of buyer that's looking to buy that property. Earlier we talked about cat piss. Cigarette smoke
is way easier to deal with.
Completely different.
Not even close.
Yeah, completely different thing. I mean, there are machines that you can put into these properties to get the smoke out in a couple of days, to get the smell out. But in most cases, you're going to have to paint, replace carpet, that sort of thing. And if you do that, chances are you're going to get rid of it. So at the end of the day, probably less than you think with regards to effects to value. But it just depends on the buyers and who's looking at it. I've got one right now that's going to the market on Friday that's going to fall into that category, and we're going to see how it affects the value. I'll be able to tell you in a week or so if it affected it or not. I'll be able to come back with real data, real information.
About 10 years ago, I bought one that had been smoked in so heavily that it appeared to have yellow window tinting on every window in the house. And that gave an awesome vibe that in addition to the smoke stench, it was like this hazy, weird yellow light coming through the house. But even with that, it was within a week, we had it all out.
There you go. Eric Gutierrez, $2 super sticker. Thank you, Eric, for that. What was the super sticker here? Let's see. It's a pear. It's a pear. Avocado. Hey, you. I don't know.
I prefer pears.
Anyway, thank you for that. Ionizers. Is that what they're called? I have no idea. Question mark. Ionizers? Question mark. Is that what the machines are called?
I think so, but I don't know.
All right. Anyway, let's move along here. Let's see.
I got one here.
Go ahead.
Rishi Simply back with another question. My question is it correct to say that the advantage that buyers get right now because of low interest rates are offset by huge surge in home prices, hence bad idea to buy right now? Those are the elements of affordability. What goes into affordability is what is our household incomes doing, what are home prices doing, and what are interest rates doing. So we have, for those that weren't impacted by the pandemic, we've got good incomes, we got really low interest rates, we got really high house prices. So when you look at affordability in the context of percentage of household income going to a monthly housing payment, we're barely above the long-term trend. So the question here is it a bad idea to buy right now? Depends on what happens going forward. If home prices come down, but interest rates shoot up, Jeb's done some numbers and run some figures on this. Doesn't really help you in terms of a monthly payment. And you would have to be able to guarantee that home prices are coming down. We talk here every week. Home prices are a function of supply and demand. We have a massive undersupply of homes, and we have increasing generational demand among millennials. So you will get some pressure, some limit, a break on the increase in home prices based off of less people being able to afford as prices go up, and or if interest rates were to go up. But with that being said, I don't see anything on the horizon in the next couple of years that's going to cause prices to be lower. So unless you thought interest rates were going to go even lower without prices going higher, in terms of affordability and a monthly payment, I don't know that we have a better entry point than where we're at right now.
All right, got a couple more questions here. Try to knock these out because we're pushing 2 hours here and stay within the confines of our agreement with YouTube. No, just kidding. With our wives. And let's see here. This is a good one from JW. I want to sell in California, move to Texas, but my credit and income is so-so. I have a lot of equity in my current property, enough to theoretically trade out. What's the best way to finance that, Josh? I would say, let me answer it the first way, is that if you've got enough equity to buy a property outright, the best strategy would be to sell your property and do that. Now, if you need a loan of any sort, Josh, what would be the best way to strategize?
Well, you say credit and income is so-so, but if you're leaving California and going to Texas, does the job travel with you? Are you able to work remotely, or are you going to have to get a new job there? So that would be the big question in terms of qualifying for a new loan there. Since you could pay cash, I would assume you're going to put a fairly large down payment. And once you get to 40, 50% down, you're going to get close to the best terms regardless of what your credit scores look like. And I say that down to maybe the 620, 640 level. You go below that, yeah, you're going to pay a premium for it. So just looking to strike a balance there. I think it's always a good idea to carry a mortgage if you're of working age. In this situation, it would allow you to keep some additional reserves, maybe invest a little, get an IRA or a 401k stocked up so that when you arrive at retirement, the house is likely paid off and you have a few more assets. But it shouldn't, marginal credit or a slightly lower income shouldn't prevent you from getting a loan of some sort when you move to Texas from California. But like Jeb said, you're probably going to want to sell before you go regardless.
All right. Dr. Sharifa Clark just started watching. Don't know if this question was answered. If buying new construction, can builder cancel contract without reason? Again, it's going to boil down. We've talked about this. Builders have their own contracts. They don't use standard contracts, state contracts. Like here in California, builders don't use California residential purchase agreement. They have their own. I don't know what it says exactly in there because each builder is a little bit different. Chances are it gives them the ability to do what they want. Now, will that happen? Chances are probably not, because it would be bad press. It would be, there's a lot that goes into it, but could they technically do it? Potentially. Josh, anything you want to add on to that before we move on?
No, that's pretty much it.
All right. Julia has been on her job for 6 months. Does she need 2 years to pre-qualify?
It depends on what you were doing before. So it sounds like you've been at your current job for 6 months. Were you on another job for the previous 18 months? We need a 2-year work history. Now, when I say that, we have two things that are pretty common that come up where that 2-year history isn't in the last 2 years. We have situations where someone was in school. either they just graduated and never had a job, or went back to school and got an advanced degree and come back into the workforce. And with that, we show, and it doesn't have to be a degree, we show the degree, certificate, whatever schooling they got that now they're able to use to get the current job. And then we go back prior to the schooling if they're not just kids graduating from college, and build that 2-year work history. The other one, we have parents who had a child and took some time out of the workforce. I've had it 15, 20 years. I have people that wait till their kids go to college and mom says, I'm gonna go get a job now. So it can be really difficult to go back 20 years and build a 2-year work history. But the 6 months is after a gap of employment. We need to have you back on the job.
All right. Halasan Santos gave us a $10 super sticker. Thank you for that. And also ask a question. Have you guys seen a listing agent questioning Quicken Loans as a lender, asking the buyer to look for another lender?
Only smart ones.
Yeah. Yes. Yeah. In some cases, right? I mean, the problem with Quicken Loan, it's hard to have a conversation with the agent, the mortgage. I won't use a professional with the person on the other side of that to find out the real qualification. So in some cases, they don't really do a true pre-approval on these. It's like it's more a pre-qualification over the phone. No income, documentation wasn't done, so you don't really know what you're getting. And sometimes you can get these done online without having to provide anything. And so the listing agent is just trying to protect themselves as well as the seller to make sure that you're truly qualified. So you could go out and get a second opinion, if you will, maybe with their lender or someone else. And if you still wanted to use Quicken, you could do that. But they're just, they want some validity that you're actually approved. So it does happen. It's not insane for that for a listing agent to request that. I mean, as someone that sells property all the time, I mean, if I see something that I don't really like in a pre-approval, I might ask a buyer or their agent to say, hey, listen, can you have them pre-approved with someone else, just so that we don't, make sure we're not making, any mistakes here. And if the buyer wants the property, if you want the property, do it. It's easy to do. Shouldn't cost you anything to get that second opinion. And then you could end up going with whoever you want. You're not going to be required to go with that other lender if you still wanted to use Quicken for whatever reason.
So a little insight into that. Quicken won't have a conversation with the agent. They issue what they call a guaranteed pre-approval letter and says they will pay the seller or their agent $1,000 if the deal doesn't come together. Most agents aren't willing to bet $1,000 on their reputation or risk losing a listing that could be $8,000 or $15,000 or $20,000 of commission for a $1,000 guarantee from a kid in a call center. So when you can't talk to them, you can't vet it, and you just have a letter that says, take our word for it, we'll pay $1,000 to someone if the deal falls apart, agents don't love that. And then on the flip side, I always like to ask, when you have someone that just wants to use Quicken Loans that bad, why do you want to use Quicken Loans that bad? The last loan that we did where we had to do a cross qual for an agent who was not willing to risk their reputation for a $1,000 pre-approval letter. It was a big loan. It was an $800,000 purchase, but it was a $17,000 difference in cash to close at the same note rate between what we offer and what Quicken offered. And that's common, 8 days a week. You get very average rates from a kid in a call center who's done loans for 1 to 2 years. So if you like TV commercials and you like a sweet app, it's worth going with Quicken Loans. But really, other than that, that's all you're getting is a marketing package. You are getting the McDonald's of mortgages.
There you go. You heard it from a pro. Christian rather, sorry for butchering that. What do you think about the housing market in Palmdale, Lancaster? So I don't know it very well. I know it's a hot market because a lot of people are moving out of LA up into that market. In fact, just had a referral from YouTube actually close here recently. A viewer reached out, needed an agent up in that market, referred them to a pro that I know in that market. They went under contract. They actually closed about a week ago.
It's not.
There you go.
Get in for me.
Hey, don't give nothing. Yeah, we'll put you in,
Adrian.
Yeah, we'll put you in touch with Adrian if you need an agent up in that market. Got somebody that
he did a great job for those guys. Great job.
And a real professional on that side. So if you need that referral, reach out to me. I'll put a email addresses up here shortly if you'd like that contact information. We're going to answer one more here. Let's see. Let's find it, and then we will move along. We'll go Bill the Man. Bill the Man. Bought a second home in San Francisco Bay Area. Should I hold on to my first house? what makes sense to you? Can you continue to do both? Do you want to be a landlord if you decide to rent it out? Do you need the cash from that property to do something else? All things that you need to consider. I don't think there's a straightforward answer here. I do think property values are probably going to continue to rise for some time. So holding on to that property, at some point it's probably going to be worth more money. And so if the numbers make sense to keep it now, I would say it's probably not a bad idea. I always encourage clients, if they're buying something else, if they can keep their property and they're okay with either renting it out and being a landlord and or having a property management company do it, long term, they're going to be grateful that they did that. I don't think you have any grandparents that have owned multiple properties over the years that they bought and held on to, that they're having second thoughts of that they're mad that they held on to these properties. I mean, long term, I think you're going to see value in holding those properties because of the direction that things will likely go. Josh, anything you want to add here? We're getting to the end of the show. If you guys are still watching, you haven't done so already, hit that subscribe button, or not that subscribe button, that like button. Again, it's the only thing we ask here. I'm going to throw up some email addresses so you have those. If you'd like to contact Josh and I, if you need a lender anywhere in the United States, if you need a realtor anywhere in the United States, and you want to work with a pro, people like Josh and I, we will put you in touch with them. But final words here, Josh, tonight.
I was just gonna say, even viewers in Maine, we can connect with lenders.
That one today
strained the limits of. I mean, I don't even know. We can get. Isn't Maine the absolute furthest away on the top right, or is there something further out there?
I believe if you're in the Continental, that's going to be the furthest away. Or maybe you could go Florida. I'm not real sure which one. I guess Maine's probably the furthest away from California.
And again, I would just say, going back to the whole Quicken thing, if you want to use an online lender, just don't use them in a vacuum. Shop them against someone local. Usually, I'm not going to say there aren't bad local lenders that you would talk to someone and not have a great experience or get a higher quote. You're going to save money. You're going to deal with someone locally who answers their phone, will talk to your realtor, will follow up on your offer, and greatly increase the likelihood of you getting an offer accepted.
No, absolutely. So, just make sure you're out there, you're working with a pro. It's going to make your life a lot better, make the process a lot easier. You're going to be a lot happier in the end by doing that. But that's going to be it for this week. If you have additional questions we didn't answer, put them in the comments. I go back and address most of those and try to get you answers. But we appreciate you taking the time to watch. We appreciate all the support, and we will see you again next week. Have a great day, guys. Bye-bye.